Have you ever wondered how you as a high income earner can maximize on your mortgage options when it comes to buying your first property? If so, you're in the right place. In today's video, we'll be uncovering how to leverage your high income to make sure you can secure the best mortgage deals. We're also going to look at some insider tips that you can use to maximize your mortgage options. And lastly, we'll be looking at common pitfalls that you want to make sure you avoid when it comes to buying your first property. Now, if you like these types of videos where I share the tips that will help you to fast track your property journey, then make sure you hit the like button, smash that like button to let me know, and make sure if you haven't already done so, you subscribe to make sure you get notified as soon as I drop a new video. So first up, let's talk about leveraging your high income. Now, as someone who's earning a higher income, it comes as no surprise that you are at a significant advantage. Lenders will be willing to offer you much more competitive rates and higher loan amounts. So here's how you can make the most of this. First up, let's talk about deposits. Now, quick side note, let's not get it twisted. When your income goes up, what usually happens is people's expenses go up as well. But I'm hoping that you're one of the smarter high income earners who made a decision at some point to say, the larger the gap between my income and my expenses, the more I have available to save towards my deposit. Because if you've done that, then having a larger deposit that you can put down will give you access to much better mortgage rate. Put it like this, if you put down a 5% deposit, you are going to pay a much higher interest rate compared to someone who can put down a 20% deposit or a 30% deposit. Now let's talk about credit scores. As a high income earner, you will have access to much more credit than someone who's on a lower income. Before you go crazy, I want you to be smart about how you use this to your advantage, because your credit history is essentially a digital report which gives lenders a rough idea on whether you are someone who is trustworthy to repay them any money that they lend to you.
Pay me my money.
And it's important you understand that it's all about risk at the end of the day. So as a high income earner, if you have got credit accounts, make sure you're repaying them on time and consistently, because ultimately a consistent track record on your credit history will help to strengthen your position when it comes to your mortgage applications. Now let's talk about something that high earners really appreciate. High value professional advice. Now don't get me wrong, I'll be the first to tell you that it is possible for you to get a mortgage without using a mortgage advisor like myself. It is also possible to approach some mortgage advisors who won't charge you a fee. But something that's common with a lot of our high income earning clients is that they value and appreciate the importance of saving time to get the best possible results, and they'll pay a fee if it's about to help them. Because ultimately, if an advisor is able to help you not just to find you a basic mortgage deal that you can find for yourself, but if they're able to help you to find the best deal that positions you to be able to buy a second property in a very short space of time, and they're able to help you to save £20,000-30,000 in the process, I think you'd be happy to pay the fee. Now let's move on to some insider tips. Now, did you know there are specific mortgage products that are designed for high income individuals? I'll run you through a few of them just to give you an idea that might give you some options. First up, we've got offset mortgages. Now let's say you're somebody who has saved up a large amount of money, but you don't want to put all of that money down and tie it all up into a mortgage deposit. Now with a straightforward residential mortgage, what usually happens is, let's say you've got a property that's worth 100k, you would put down 10k as a 10% deposit, the lender lends you 90k as a 90% loan, and they would charge you interest on the total amount of the 90%, right? And that's usually how it would work. And let's say that rather than having 10k that you can put down, you have up to 50k. But for one reason or another, you're not really keen on investing and tying all of that money down into that property. What you can effectively do is still put down a 10% deposit and take the other 40k and leave it in a savings account that is tied to your mortgage. So rather than charge you interest on the full amount, they'll only charge you interest on the difference between what you've put down and what you have saved, and the remaining difference of the property purchase. And that can be a game changer for a high income earner who maybe has funds that they want to use or have access to at a different point, rather than tying it all up into the same purchase. Another mortgage you can benefit from is an interest only mortgage. Now these are usually most common when it comes to investment properties, and as a high income earner, rather than tying up all your capital in one particular property, you might put down a deposit for the purchase that you want to make to live in, and take the additional funds that you have to purchase other additional investment properties which are on an interest only basis. By focusing on an interest only mortgage for the investment properties, it gives you the opportunity to maximize on more of the rental income that is coming in each month. Lastly, there are also flexible mortgages. Now most mortgages usually give you the opportunity to overpay by around 10% each year without having to pay any early repayment charges if you're in a fixed term, but depending on your objectives, there are actually mortgages which allow you to overpay more. So as a high income earner, that might be something that's attractive to you if you're planning to pay down the loan amount much sooner than you've got the loan term for. And with a stronger financial background behind you, there are also mortgage options that allow you to benefit from things like payment holidays. Now, all of these options can significantly impact your financial strategy and how you plan to build and grow your wealth. Now, finally, let's talk through some common pitfalls that high earners should avoid. First up, overstretching your budget. So here's the thing. I understand that you've worked extremely hard to build up the income that you're earning at the moment, right? You sat in the negotiations, you did all of the hard yards, you spent all of the hours over delivering in your workplace and more, right? But just because your income allows you to borrow more, it doesn't mean you should over leverage to the max. When it comes to borrowing of any kind, regardless of your income amount, it's extremely important that you stay within a comfortable budget. So don't make the mistake of just looking at whether you can afford to make today's payments. Stress test your income, right? This is where some people have gone wrong over the last couple of years and have found themselves in properties that they can no longer afford and they're being forced to downsize, right? So you really want to think forward about, if interest rates to rise, what will be my plan? How would I be able to afford it? Do I have alternative means that will be able to support any additional spending that I might have to spend on the property? Let's be real, home ownership comes with additional costs because maintenance becomes your responsibility. You don't have a landlord that you can call and say to them that there's a leak in the house that they then have to repair. It becomes your responsibility. If something is to break, the boiler, for example, can be a pretty expensive repair. So you want to start thinking forward about how you can strategically prepare so that you're in the best possible position for all possible outcomes. Another pitfall would be ignoring your future plan. Yes, you might want to live in a particular location for this particular amount of time, but what are your long-term objectives? If you know that, for example, in the next 2 years, you have plans to move somewhere completely different, then you might want to approach what you do with that property and how much you borrow against it and what your strategic plan is over those 2 years a little differently compared to if you were planning to stay there for the longer term. So think about your long-term objectives as well when you're making a decision on which property you're going to purchase and how much you're planning to borrow. And lastly, another common pitfall is not shopping around. Now I get it, a lot of our high income clients are very busy people, they just don't have the time. And a mistake that people in that situation might make is going to their existing bank and assuming that by applying for a mortgage there, that's the best possible deal available, right? Unfortunately, loyalty doesn't always pay. And that's the reason why it's very, very crucial that you search the market. Even if you don't want to use an independent advisor like myself, at least do your due diligence to try and search the market and compare options, right? Figure out the different criteria that different lenders are looking for to make sure you're actually a good fit in the first place, right? And again, you do always have the option, if you're looking for the help, to use an independent whole of market advisor like myself, who can do the work for you to do a whole market comparison and find the best deal for your situation that you are most likely to have success with. So to summarize, as a high income earner, you have plenty of opportunities to maximize on your high income earnings. There are mortgage options specifically tailored for you, and there are ways that you can strategically use your income that you've worked so hard to build up to get the best out of your first property purchase. And of course, there are pitfalls you want to make sure that you avoid so that you can get the best possible outcome in the long run. Now, if you found this video useful, make sure you hit the like button to let me know and to let YouTube know that you want to see more videos just like this one. And if you haven't already, make sure you hit the subscribe button and smash that bell so that you can get notified as soon as I upload another video to help you fast track your property journey. See you in the next video.